Yo, what's up, guys? Welcome back to another video of Wise Well. Today, I want to talk about value investing. In this video, we already talked about growth and dividends, but essentially, what value investing is you find a company that's underpriced, that's less than its intrinsic value, and now you're going to say, "Well, George, what is intrinsic value?" And basically, all intrinsic value is basically all it is you use fundamental analysis to value a company. That's all you do. You use fundamental analysis and you calculate the value, what the company should be valued at. Like, how much is it worth? How much money is it making? Um, all that. And after you find the intrinsic value, you look at what it's actually valued at. And if the company is valued less than the intrinsic value, as we can see right here, then you might have found a value investment. And in general, value investments are considered less risky. Why? You ask, are they less risky? Less risky than, let's say, crypto or, you know, growth stocks even. Why are they less risky? Because in long term, market likes to correct itself. 9 times out of 10, the market will correct itself. It moves in cycles, and in the long term, it will correct itself. So let's do an example. So we have company XYZ valued at intrinsic valued at $50 a share, right? But what's it actually priced at? $40 a share. So the $50 a share, this is an intrinsic value. What's the $40 a share? Market value currently. And now what's going to happen here? This this $40 a share in the long term should go to 50 a share. Why? Because market corrects itself 9 times out of 10. So how much profit do you make on this? So, well, if you start at 40 and it goes to 50, you're going to make $10 a share, or a 25% profit. Which this is why value investing can be so great, because if you actually find a good investment, usually the market's going to correct itself to go to what the actual value should be. And now you're going to say, okay, well, this makes sense. So if a company's less than its intrinsic value, it might be a good investment. But how do you calculate intrinsic value? Um, in general, there's two very common ways that you can calculate intrinsic value. The first one is using discounted discounted cash flow, or DCF. You probably heard of DCF before. Very common. So essentially what this is um, when an investor, or you in this case, projects a company's future cash flow, then discounts it, discounts it to today, discounts the future cash flow today, I should say, discounts. And what does this mean? What do you mean discount it to today? Well, the cash flow in the future is going to be worth less than the cash flow today. Why is that? Because this essentially accounts for the fact that money today is worth more than money tomorrow. Why is this? Because over time, money decreases in value. more money's printed, more money's circulated, it just decreases in value. That's just how the world works. So, and everyone should know this. What is this called right here? The time value of money. Very important to know this. Over time, money will lose its value because more is printed and et cetera, et cetera. However, uh, this is the first model, discounted cash flow model. You essentially project the cash flow for the future of a company, and then you discount it to today. The second, the second model is a dividend, discount model, or DDM. And essentially, what that is essentially what dividend discount model is. You do the same thing. Project. You project you essentially project the um I'm blanking right now. You project the future dividends and then discount it today again. Then discount to today. And what does this do? This allows an investor to see to or to predict rather to predict how much cash they can get off their investments. Um, and the main point here is that if stock is trading less than the intrinsic value, you might have a valued opportunity. Um, and the other way you could do this, besides the DCF and the DDM, you could just compare the company to its peers. To peers or like indexes. And you could use various aspects. You could use cash flow, you could use PE ratios, all that. I personally like to do this. I like to actually calculate the value, but this is also not a bad way. Now, the only thing with the only thing with value investing is that there's this thing called value traps. They have to be you have to be on the lookout for. What is a value trap? So you might say XYZ is uh XYZ is less than its intrinsic value, right? Well, that might be true. It might look like that. It might look like that. Looks like value opportunity, but is it actually value opportunity? No, it's not. Why is it not a value opportunity? Because it's a horrible company. Why is it a horrible company? Because if you look at it, maybe it should be that cheap because they're just a bad company. For example, maybe they have lots of debt, bad margins, uh, bad cash flow, which means they're not making any money, bad opinions on the company, and what is all this going to lead to? Company losing money. So let's say XYZ lose, and who would want to invest in a company that's going to lose money? I mean, come on, that's just basics. If you're going to put your money in a company, put it in a company that's going to make money. So just in general, you have to watch out for these value traps. A company may look undervalued, That's because it should be undervalued. It should actually be that cheap because they're just a bad company. So to recap, you have value investing is essentially when you value a company and it's trading at less than what it should be trading at. And the whole concept of this is you buy it, and over the long term, it'll correct itself to what it should be trading at. And how do you calculate intrinsic value? Well, there's two popular ways. You could use the discounted cash flow, DCF, or you could use the discounted dividend, which is DDM, which essentially calculate the future cash flow for the future dividends, and you discount it to what it would be today. And why is that? Again, maybe the most important thing right here, time value money. Over time, money's gonna be worth less. So, and then off top, of course, you have to also watch your value straps. But yeah, essentially that's what value investing is. It's not that complicated. I mean, obviously you can go more in depth, which I'll make another video on valuation methods. But essentially this is just the basics. You find a company that's undervalued, and over time it will increase in value to what it should be worth. Um, but yeah, value investing is also a great way to generate or expand your portfolio rather and create more wealth. Yeah, that's essentially it. Thanks for watching. I'll make another video in the future about like probably ETFs. Thank you.